Hello, everyone, and welcome to our live event today. Thank you so much for joining us. My name is John, and I'm your host from the Questrade education team. And joining me shortly are our very special guests from the Zolo team. Before we get started, let's quickly go through some important notes for the event today, along with a disclaimer. After that, we'll move right into a quick introduction of our speakers today. And lastly, we'll wrap up with a live Q&A period near the end of our webinar. Please remember that the information conveyed in this webinar is for informational educational purposes only and does not constitute advice or recommendations by Questrade or Zolo. If you have any in-depth questions about your personal investment or tax circumstances, please consult with your own advisors or professionals for more information. Now, without further ado, I'd like to introduce our special guest speakers today. Meet Jordan Kay, Content Marketing Manager and Spokesperson for Zolo. With over a decade of experience in personal finance, Jordan's a sought-after millennial money expert, having been featured in major publications like the Toronto Star, the Globe and Mail, CTV, CBC, Global News, and much more. Jordan's also joined by Alyssa Davies, content manager, Zolo spokesperson, and a published author from Calgary. She's the founder of award-winning personal finance blog Mixed Up Money, and also co-hosts the personal finance podcast Money Feels. Alyssa and Jordan are extremely passionate about educating and empowering first-time homebuyers to help them achieve their financial goals. We're very excited to have them here today to present. So without further ado, I'd like to pass things on for the main event. Thanks again, Alyssa and Jordan. Take it away.
Hi, everyone. We're so happy to be chatting with you all today. And you're first probably wondering who Zolo is and what we're all about. So Zolo is actually Canada's biggest independent real estate marketplace, and more than 10 million people use either the Zolo website or app each month to stay up to date on the latest listings, market trends, housing data, all that good stuff. And if you're thinking about buying or selling a home, you can check out Zolo Homebase. That is the blog that Jordan and myself run. It's full of information about the whole process. So whether you're a first-time home buyer or a seasoned real estate pro, we've got something for everyone. And we're super excited to be chatting with you all today about the FHSA. I will let Jordan kick off our presentation.
So we are going to dive right into it, starting with what is the FHSA? So a little bit of background. The federal government announced the First Home Savings Account in 2022 in their federal budget. So this new account, which went live on April 1st of 2023, is designed to help Canadian homebuyers save for a down payment on their first home by giving them a tax-advantaged account for their down payment savings. Now, with this new account, first-time homebuyers can save up to $8,000 per year or $40,000 total. And the account has several unique advantages. So here's how it works. As I said, you can contribute up to $8,000 per year, $40,000 total. And those contributions are tax deductible, which means that you can claim the contributions on your taxes as deductions, which will help you pay less tax and actually may increase your tax refund if you're getting money back that year. The money you contribute to your FHSA grows inside the account tax-free. And when you're ready to withdraw it, there are no tax implications. The money is tax-free. You do have to use the money in your FHSA within 15 years. And if you don't use the money, you can move it into an RRSP or RRIF or withdraw it and pay tax on the total amount.
Awesome. So the what, now we'll go for the why. So when it comes to why the FHSA was created and why we need this account, I think it's really important to always talk about the average cost of a home in Canada, just to put things in perspective. So obviously this price varies greatly depending on where you live and what type of home you own. But according to the Canadian Real Estate Association, the average home price in Canada as of August 2023 was around $650,000. Obviously, this price will be significantly higher in major urban centers like Vancouver and Toronto. So I'm sorry if you live there. But knowing that, homes are expensive. And obviously, you need a pretty hefty down payment to buy one. So if you were purchasing a home at the average price in Canada, you would need a minimum down payment of over $30,000. That is just 5%, and that is not a small amount of money, especially when we consider the average salary in Canada, which according to Stats Canada is just over $59,000. So you basically need a full year's salary to buy a home when you consider things like closing costs and moving costs and all that good stuff. So again, these are minimum down payment requirements, and some lenders will want you to have more depending on your credit score, employment status, other factors. Plus, you yourself just might want a higher down payment so that you can lower your monthly mortgage payments and reduce the total interest that you'll pay over the life of the mortgage. So on that note, and because of the high cost, the primary value of the FHSA is that it allows individuals to save money tax-free, which Jordan just kind of went over really thoroughly. This results in significant savings over time, and it incentivizes you because you can withdraw the funds from the account without paying tax on the earnings. So it can help you boost your down payment, increasing or helping you reach your goal amount quicker, save or invest money tax-free, and hopefully just make homeownership more accessible and affordable, which we definitely all want. And lastly, it also frees up your TFSA. Sorry, we're throwing so many acronyms at you, your tax-free savings account for retirement savings or for other financial goals, which is currently the most popular account for down payment funds for over 50% of Canadians. That's something we found in a recent Zolo study. So the FHSA just gives you that account back for other goals.
So it sounds pretty awesome, right? But are you eligible for the FHSA? That is the $40,000 question. Unfortunately, not everyone is eligible to open an FHSA. This account is designed to help first-time homebuyers enter the housing market, which, as Alyssa mentioned, has been like super challenging in the last 5 years. So to open this account, first and foremost, you need to be a first-time homebuyer. But that's not exactly as intuitive as it sounds. There is a legal definition that the CRA uses to define what a first-time homebuyer actually is. And this is the definition. You can't have lived in a home that you or your partner owned in the current calendar year or in the previous 4 years. So if you've never bought a home and your partner's never bought a home, then you're probably eligible. But if either of you have been homeowners before, it's important to just double check to make sure that you are in fact eligible. There are a few additional eligibility requirements, but they're more administrative. So you need to be between the ages of 18 and 71, and you have to be a current tax resident of Canada. So based on these eligibility requirements, most people who have never owned a home before will qualify to open an FHSA.
So the contribution room, Jordan already made a joke about it, but the contribution room for the FHSA is based on a cumulative lifetime limit of $40,000 per account holder. You can contribute up to $40,000 to your FHSA over the 15 years that you can have it open. And there are also annual contribution limits for the FHSA. So the maximum annual contribution limit is $8,000, but any unused contribution room can be carried forward to future years. So with that, even though the contribution room is $40,000, your investments can grow tax-free for up to 15 years to any amount for your eventual withdrawal. This obviously is dependent on the market and how quickly you can contribute to the account, but it's still an amazing tool in that regard. And keep in mind that the contribution room for the FHSA is separate from other registered savings plans in Canada. So those are the acronyms that I said. So the RSP, or Registered Retirement Savings Plan, and the TFSA, the tax-free savings account. So you can use all of these accounts and take advantage of all of the benefits that they offer.
Okay, we just threw a lot of information at you guys, a lot of acronyms, a lot of numbers. So let's just do a little recap and look at the pros and cons of this account. So first of all, the FHSA is not a perfect account, but it is a big step forward from the tax advantage accounts that have already existed to serve Canadians looking to save for their first home. But again, it's not perfect. So on the plus side, the FHSA lets you contribute $8,000 per year, $40,000 maximum. Your contributions are tax deductible, which can lead to bigger tax refunds, and then any contribution room you don't use in a year. So for example, if you open your account and you're only able to put $5,000 in it 1 year, the excess contribution room, which would be $3,000, would be carried forward. And then when it's time to make a withdrawal, the qualifying withdrawals are tax-free. Again, this account is not perfect and it's not for everyone. So on the con side, to use this account, you have to be a qualifying first-time home buyer. And then you also can't withdraw money willy-nilly from this account. So your withdrawals have to meet certain requirements. Otherwise, they'll be counted as income in the year that they are withdrawn. So if you withdraw money for anything other than a home down payment, you will lose that contribution room forever, and the money will be counted as income. So you need to meet certain requirements when you're making your withdrawals. Overall, though, it's a very flexible account.
Okay, so now you're thinking, this all sounds great, but should I open this account? Does it make sense for me? And I always think there's a few questions you can ask yourself to make a decision like this. So the first one is your savings goals. Are you even planning to buy a home? I know it sounds silly, but it's still a good question to ask, as well as when are you planning to buy a home? How much do you need? You might find that that $40,000 limit is too low given the cost of homes right now, and you'll need to use other tools as well. So either way, just thinking about your short and long-term financial goals is always the first step when you open any new account. The second one is one of the biggest advantages of the FHSA is its tax benefits. So although you contribute to the account with after-tax dollars, any investment earnings are tax-free and those withdrawals are also tax-free. You'll want to consider your risk tolerance. If you plan on buying a home in the next 5 years or so, you'll want to be mindful of how you invest the funds in your FHSA. So you can choose to invest in publicly traded stocks, ETFs, bonds, more. You'll want to consider, though, whether the risk of losing money makes you nervous. As Jordan said, make sure you're eligible. And lastly, remember that you have other savings options too. So the RSP home buyers plan and the TFSA are also great options that offer tax benefits. So it's worth exploring those as well before you make your decision.
So speaking of other accounts, there are two other accounts that Canadians have typically used to save for their home down payments. And one of them is the TFSA. So let's just do a quick little side-by-side comparison to see the differences between the two. So the TFSA, which stands for tax-free savings account, and the FHSA are both registered accounts, and they can both be used to save for a home down payment, but there are some big differences. One of the biggest differences is how taxes work with each account. So when you contribute to your TFSA, the contributions are not tax deductible, which means you won't claim them on your income tax return, and you won't get any tax deductions or money back for making contributions. Once the money is inside your TFSA, it will grow tax-free, and your withdrawals are also tax-free. The FHSA, in contrast, allows you to make those tax-deductible contributions that you can claim on your income tax return, and then when you withdraw money from your home down payment, those withdrawals are also tax-free. The second biggest difference, and some people can run into a little bit of trouble with this if they're not paying attention, is the contribution limits. So the federal government sets the contribution limit for your TFSA, and that limit accumulates every year starting when you turn 18, regardless of whether you open a TFSA or not. And just as a sidebar, if you don't know what your contribution room is for your TFSA, you can check that through the My Account feature on the CRA website. So whenever you make a contribution to your TFSA, it will reduce your contribution room. But when you withdraw money from your TFSA, you get that room back the following year, which is what makes this account so popular for short-term savings goals, because you can save money in it, you can withdraw money, and you get that room back the next year. The FHSA contribution limit is much more straightforward. Like, you contribute $8,000 per year starting the year you open it, up to a lifetime maximum of $40,000. You can carry those unused contribution room forward. And then finally, the last difference is how withdrawals work between the two accounts. So you can withdraw money from your TFSA anytime for any reason. Usually it's as simple as just initiating a transfer through your bank. Your withdrawals are tax-free, and you get that contribution room back next year, which I had mentioned. And then this is what makes the TFSA so flexible. Withdrawing from the FHSA is also tax-free, but the withdrawals are much more structured. You can only use them to purchase a home, and you do need to fill out some forms to be able to do so.
Okay, so now we'll talk about the differences between the FHSA and the RSP home buyers plan. So not the RSP, but the HBP. So the HBP, the Home Buyers Plan, is a program that allows you to withdraw up to $35,000 from your RSP to buy or build a qualifying home. And the best part about this plan is that you don't have to pay tax on this withdrawal as long as you repay the amount back into your RSP within 15 years. So it's definitely worth considering if you're planning on buying your first home and you've already been contributing to your RSP with this intention. So you might have been saving for a home before the FHSA existed. If you're purchasing a home with a spouse or a common law partner, both of you may be eligible to withdraw up to $35,000 each from your respective RSPs under the HBP. So that's $70,000 right there. And the same goes for the FHSA. Both you and a partner that also qualifies can withdraw the funds to increase your purchasing power. If you're withdrawing for the HBP, sorry, all the acronyms, the process is really similar to that of the FHSA. You have to complete a form. I believe it's the T1036. And then you must use these funds to buy or build a qualifying home within 30 days of receiving them. The last thing to note with these accounts is that if you withdraw funds from the RSP under the Home Buyers Plan, you must repay those funds, which I mentioned, over a period of up to 15 years, starting in the second year after you withdraw. So you kind of have a buffer room after you buy your home. You'll need to make a minimum repayment each year, but you can choose to repay more if you want to. But the main difference and one of the main benefits of the FHSA is that there are no repayment requirements for withdrawals from this account. So it's one less payment to worry about once you own a home, because if you are or know anyone who owns a home, there's a lot of expenses that go with that.
Okay, so we covered the 3 tax advantages accounts available to Canadians looking to save for their first home. And so here's just a quick recap and like a side-by-side comparison. So first off, we have the TFSA, which is definitely the most flexible of the 3 accounts. The TFSA allows you to contribute and withdraw money with no penalties, no taxes, and no need to repay any loans to yourself, but you don't get the tax deduction for your contributions. Then we have the RRSP, sort of on the other side of the spectrum, where you get the income tax deduction for your contributions, but you're limited to withdrawing $35,000, and you have to pay that money back to yourself over 15 years as sort of a loan from yourself. And then we have the FHSA, which is really best of both worlds. So you get the tax deduction when you make your contributions, but you don't have to pay tax on withdrawals, and you don't need to make repayments to yourself over time. It has the benefit of both the TFSA and the RRSP, which is why I think it's primed to become the most popular way to save for a home in Canada. And then I should also note that you don't have to pick one of these options. You can use a combination of 2 or even all 3. You could use the Home Buyers Plan and the RRSP and the FHSA together. Like Alyssa said, if you've already been saving in your RRSP for your home down payment, you can still use that. Or say you max out your FHSA and your RRSP, you could even add a little TFSA action in there. It's really up to you and up to how much income you have every year to make your contributions.
So I'm just going to toss it over to John so he can explain to you quickly how to open an FHSA with Questrade.
Thank you so much, Alyssa. So getting set up with Questrade is super straightforward. Many of you guys on the call are probably already existing Questrade customers with TFSA's RSP accounts, but even for those of you that aren't, it only takes about 5 to 15 minutes online. So if you don't have an account already, simply head to questrade.com and click the big green Open an Account button. On the next page, you're going to choose whether you'd like a self-directed account or one that's managed by QuestWealth Portfolios, and then you basically go through the account application. If you're already an existing customer, just simply log in, and on your home page, on your summary page, you can add another account in about 5 minutes. So pretty straightforward, and let us know if you guys have more questions. We're happy to cover them later on. Thanks so much, and back to you guys.
Should you invest in your FHSA? This is another important question that needs to be covered. So like other tax sheltered accounts in Canada, the FHSA, despite its name, isn't purely a savings account. Instead, think of it as like a tax sheltered basket that you can put various financial products into. So you can actually hold a whole bunch of different things in your FHSA, including cash, guaranteed investment certificates or GICs, bonds, mutual funds, stocks, and exchange traded funds. And while it's possible to hold all of these types of investments in your FHSA, that doesn't mean you necessarily should. So generally, you should consider your risk tolerance and how soon you'll need the money when deciding what to hold in your FHSA. So for example, if you plan to buy your first home within 5 years, then it's smart to stick to less risky options like a GIC or cash. These products don't fluctuate in value, and you can be sure that the full value of your contributions are going to be there when you need it. But not everyone who opens an FHSA is going to be using their money within the next 5 years. So for anyone with a longer time horizon, some of the more risky options like ETFs or stocks will offer a higher rate of return and will grow your overall down payment. But just keep in mind that those types of products also come with more risk for your contributions. So to recap, when deciding how to invest your FHSA contributions, it really comes down to time horizon and risk tolerance. And if you're not sure what's best for you, it happens to everybody. The folks at Questrade can help you out, or you could speak with a fee-only financial planner or a financial advisor, and they can give you advice on what to do. Okay, so you've opened your account, you've maxed it out, you're ready to buy your home. What's the deal with withdrawing money from your FHSA? You're going to need to take a couple of steps. So first, you need to have a home or find a home that meets the withdrawal criteria for the FHSA, which is a housing unit located in Canada, and the written agreement must entitle you to an equity interest in the home and not just a right to tenancy. The next thing is that the buying agreement needs to qualify. So you'll need a written agreement to buy or build a qualifying home before October 1st of the year following the year withdrawal. So if you're withdrawing this year, you need to be buying or building a home before October 1st of next year. The CRA loves to make things complicated. You can't have bought the home more than 30 days before making your withdrawal. So this is an important one. You have to make the withdrawal no more than 30 days after buying your home. And then third, you need to intend to occupy the home as your principal residence within 1 year of buying or building. So this is not for investment properties. This is not for cottages or second homes. This is for your primary residence only. And then as long as those criteria are met, the next step to actually physically making the withdrawal is to fill out the required form, which is the RC 725. And it's called Request to Make a Qualifying Withdrawal from Your FHSA. Very self-explanatory. And if your FHSA is with Questrade, you will upload the form to your account. Then you'll make a withdrawal request online by going to myquestrade.com, then go to requests, and then go to withdraw funds. And it's that simple.
Awesome. So the last question that's important to talk about is, what if you decide you don't want to buy a home anymore? Or maybe you've been saving for years and suddenly it's not the right choice for you, or you can't use the funds for a qualified home purchase. So there's a few options for what you can do with the funds in your FHSA account in this instance. The first thing you can do is leave the funds in the account to continue earning interest or growing as investments for that 15-year period. Alternatively, you can withdraw the funds from the account, but we've talked about that a few times in this presentation. You will be subject to tax consequences. So any investment income earned in the account will be subject to tax. So be very mindful of whether this is the right choice. I would personally speak to an accountant in this case if I was looking to make any sort of withdrawal. Finally, you can transfer the funds to an RSP or an RRIF without tax consequences, as long as it's a direct transfer. So this transfer doesn't impact your unused RSP deduction room. But if you have excess amount in your FHSA, so above that max contribution room, you may be subject to tax consequences, and this will also count as a new RSP contribution. One other thing is to note is that you can also transfer these funds to another FHSA, RSP, or RRIF to your legal partner. So someone you are common law with or married to. But again, there's also really specific rules and regulations around this option. So definitely speak to a financial advisor before making any decisions. I feel like it's really important to note that because this FHSA account is still under a year old, there are things that will be changing sometimes. So the premier place to get information about this is canada.ca or the CRA website. That is the final word, not usually the first thing you find Googling, just in case. Thanks. Thank you so much for joining us for today's webinar. We hope you learned something new, and we'll pass it over to John.
Perfect. Okay, so just kind of recapping some of the information from earlier, why it's so important to maximize your down payment or really whatever you want to use the funds for towards that purchase of the new house. So the CRA does not actually specify that it has to go towards the down payment. You are able to still use those funds for, closing costs, legal fees, paying your realtor, anything along those lines. But the important thing is to start early. Even if you start small and you can't max out that contribution right away, it still does make sense to start as early as possible to allow for the compound growth. This is just an example chart here at about 8% growth historically. And even if you can't max out your contribution right away, as you see in the chart here, and you catch up in subsequent years, it still makes sense to keep that FHSA open. Kind of following up on that, the power of compound growth and the unlimited withdrawal amount. So although you can only contribute $40,000 and actually deposit that into the FHSA, that $40,000 can grow. So if you're great at investing, let's say you get better than an 8% growth or even just 8% growth, these are some of the amounts that you can kind of anticipate here. And why you should use all 15 years in your FHSA if you can. Maximizing your tax-free growth. Just like the TFSA and RSP, you're not paying capital gains tax on your funds in the FHSA. So here's an example of just by leaving it open for an additional 3 years, how much more you could save towards that first home. If all things are equal, the housing market and the stock market and everything are level. So this is just a hypothetical example, and real world scenarios are going to be very different depending on interest rates, depending on when you want to buy a home. But just an example as why you should consider leaving your FHSA open for all 15 years. Thank you so much. So with that, we're going to jump right into our Q&A session here. So just bear with me a moment while I pull up all the questions from the audience throughout the session. And joining me shortly is going to be Adam from our Questrade studio as my co-host, who's going to be helping out with some of the questions as well. Okay, so maybe I'll kick things off with the first one for Questrade before I hand over to Jordan and Alyssa with question number 2 or 3. And I saw a couple of questions about whether or not you can open an FHSA with Questrade and use it to invest in a GIC, or Guaranteed Income Certificate. And the answer is absolutely yes. GICs are available at Questrade to be purchased online, straight through your account, and they've been available in our online platform since earlier this year. So if you already have an account, it's very easy and straightforward to purchase a GIC of your choice, whether that's a 3-month, 6-month, 1-year, 2-year, whatever you're interested in for your FHSA. So I hope that helps answer that question there. GICs are absolutely available. And as a follow-up to that, I saw a question about bonds as well. Bonds are also going to be available in the same area as GICs in the fixed income investing section. So if you're interested in buying government bonds, municipal bonds, or corporate bonds, those are going to be available there as well. Okay, so let's go over to question number 2 here. And this one should be a straightforward one for the Zolo folks. If I already have an FHSA account, does my wife qualify to open one? Let's say we don't own a home yet, neither of us. She hasn't opened an account yet. Would she be able to open that FHSA and maybe both of us use it together?
Yes, you can both have an FHSA as long as you both qualify as first-time home buyers. And yeah, again, it's a great opportunity to increase your purchasing power. So if you have the income to do so, why not?
Awesome. Yeah, the more the merrier, right? So even if you only put 40,000 in and you park it as cash, it doesn't grow. 40,000, that's still 80K for your down payment if you both use that FHSA. All right, so going through a few more here. Got one here from Michael before I hand off to Adam for the next question. And that's, can I use the FHSA to purchase a duplex, triplex, or 2-family house? So something that maybe not just my family could live in, but maybe some extended relatives and things like that?
That is a great question. As far as I know, investment properties are not eligible, but I would definitely double check the CRA website or the Canada.ca website for that.
If it's like, if you are a primary resident there though, it would be okay. So
Right.
yes,
Yeah.
like any home type is okay. Like home is a very broad definition. So yeah, like mobile homes still qualify and all that good stuff.
Definitely. I guess if it's a really nice big house, you can fit all the families in there and you're still living in there. It is still wise to chat with an accountant though, just in case.
Yes.
But in this case, it would qualify. All right. So I'll hand over to Adam for maybe the next question that he can read out.
Awesome. I just want to also thank Alyssa and Jordan for doing a great presentation there, and you too, John. And yeah, so this is the Questrade media room we're in right here. So one question I did see was about being able to withdraw using the RRSP under the HPB, the home buyers plan, and also use the funds that you've invested in the FHSA. So yes, it's a common question. You can use both in combination to put towards your new home. That is a great way to get the most out of the investment accounts when purchasing a home. So definitely something to look into. Just want to remember that with the HBP plan, you definitely are going to be repaying that over the time period, the money that you're taking out of the RRSP. But the FHSA, if you're using both of them, you will get the tax deductions for both as well. So it is a great way to put as much money as you can towards that new home. And I'm going to pass it back to, I think, John with maybe answering another question.
Great thing. Thanks so much, Adam. Great question there about HBP and FHSA. So many acronyms, right? So let us know if all this alphabet soup is confusing you guys. And I know some of my colleagues have been dropping some links in the chat as well. So keep an eye there. Got another question for Jordan and Alyssa here. And where did it disappear to? Too many questions are rolling in and it's scrolling up.
That's the worst.
Oh, yeah. And it's about whether or not an FHSA has that 60-day extension on it. So an RRSP, you can still make contributions up to the end of February. Is an FHSA the same, or is it just January to December?
The FHSA is just January to December. There's no extra 60-day period there.
Exactly, yeah. So FHSAs are going to be shorter, technically, because you only have just January 1st to December 31st, whereas the RRSP, you get that extra contribution time where you can still toss a little bit of extra money in before tax year. And then I did see a question that I'm happy to answer as well. I think we've already answered it in the chat as well, but that's if you can't contribute right away this year, can you still open an FHSA and then make up for that contribution next year? And the answer is yes. If you open an FHSA with Questrade, you sign your paperwork and you get the account opened, even if you can only deposit $100, $1,000, $10 this year, any of that unused contribution room, you're able to use next year and it will carry over. There is a maximum amount that carries over each year. So please double check on how much you're contributing next year so you don't go over. But yes, if you can't contribute the full amount this year, you can open an account with any amount and carry that over into 2024. So good time right before the end of the year. Okay, we're going to go through a few more questions here and then slowly start wrapping up around 12:45 Eastern time here for everyone, just to respect everybody's time. Okay, another question for the Zolo folks. So apart from the closing and moving costs and maybe the down payment, what else can I use the withdrawal for? Particularly if there's other fees, there's furniture I have to buy maybe for the new house or anything like that. Can I use the FHSA funds for anything?
Yes, you can use them for all of your closing costs, which is great because closing costs make up usually 3 to 5% of the purchase price of the home. And there's so many things, especially as a first-time home buyer, that you will not have foreseen that will crop up. I remember the thing for me was I had to reimburse my seller for half of the oil tank that she had filled up, and like that was unexpected. So that's the great thing about the FHSA is once you make a qualifying withdrawal, you can use the money for things other than your down payment.
It's fantastic, especially if there's a little bit extra left over. You notice something with the roof going on in the new place, you got to get XYZ done. That's why the FHSA is so flexible. Doesn't have as many additional rules on it like the home buyer's plan potentially. Okay, so I'll maybe pass things over to Adam for another question here.
Thank you. So I do see a few similar questions, and these are also pretty common. So one question is about, can the funds be contributed and then withdrawn in the same year from the first home savings account. So definitely they can. And essentially, a lot of people are usually, when it was first opening up, the account was, when it first came out, a lot of people were on their way to purchasing homes and wondering if they can do it in that time period. You can still do it as long as you're able to open the account, get the money in, fill out the form, the RC 725, and get that into us. Once we have all that, we can help you with that withdrawal, and you'll still be eligible for the deduction and be able to purchase your home. So as long as you follow all the guidelines there, you'll be pretty good. And you can definitely withdraw within the same year. And I've seen it done within shorter periods of time too. So just make sure that you talk with us when you're doing it if on a short period of time, but you can definitely do so.
Yeah, it's always wise to leave a couple extra days for paperwork and the withdrawal to actually process. So we usually don't recommend opening it, closing it right away, but talk to us. We're happy to be flexible with things and help make things happen for you. If you spot a property you need to get your hands on right away and you've got an FHSA with Questrade, we're happy to help with that withdrawal process for you and make sure all the paperwork and everything's in order. Thanks so much, Adam. Okay, a couple of questions. I appreciate some of the compliments coming up. Thank you, guys. Glad that the information was helpful and useful. And as a reminder, the learning section of the Questrade website does contain a ton of additional FHSA resources as well. The Zolo website's got some great blogs, so please feel free to check those out after the session if you're interested. Maybe I'll do one or two more questions here for the Zolo team. Okay, so if I open an FHSA account and then I move in with my partner who already owns their home, how would that impact me? Would you have any tips for someone in that scenario?
That's a great question. I had someone ask me this and I actually didn't have like the perfect answer, because once you move in with them and then you go to buy a home, that would be when they would look at the first time home buyer qualifications. Jordan, do you have any input?
I think that is something that you need to consider when planning to move into with your partner. If you have a significant amount of money in your FHSA, if it was me, that would factor into my decision to whether to move in at all, unfortunately, because like you're not considered a first-time home buyer if you're living with someone who owns their own home. So it does disqualify you, and it should be part of the decision-making process if you're making that kind of a big move.
Definitely. Appreciate the insight. And as a quick reminder, definitely recommend chatting with an accountant in this case. It's a bit sensitive. The account's new and some of the rules are a little bit unclear still from the CRA. I saw this question actually come up on Reddit last week, and everyone in the comments was all over the place on how they would approach this scenario. So in this case, technically you qualify to open the FHSA in the first place, but by moving in, you no longer qualify to make that withdrawal. Now, does that still mean you can keep it open for the 15 years? Theoretically, according to the CRA, yes, you just can't use it for that first-time homebuyer's withdrawal. So it's a bit of a sensitive topic. If you're in this scenario, we do recommend speaking with a tax specialist, since we can't answer highly specific personal questions at Questrade, unfortunately. None of us are accountants here, but hope that definitely helps maybe shed some light on that scenario there. Perfect. So we got one more question that's got a bunch of upvotes right here at the top. And that's about the FHSA tax deduction. So once you make your contribution, you're going to get that tax slip from Questrade come tax time. Can I carry that forward? So similar to an RSP contribution, you don't have to use it right away in that same year. With an FHSA contribution, can you carry that forward to future years?
I do not know the answer to that. This is the first year it's been open. So this will be the first year that people will be filing their taxes and doing that. So that's a great question.
Absolutely. Even from our side, I believe the CRA will treat it like the RSP, but we can't guarantee that. So I'd recommend double checking the CRA's resources come tax time, January, February, right before you file, chat with your accountant. Pretty good chance they will treat it like the RSP where you can carry that forward, but they haven't released the guidance on that 100% quite yet. So can't give you guys a definitive answer, but appreciate the question.
I think currently up to this date, what we know is that you can carry forward that into the next year, any unused space. But then what happens after that year it's a little far out. Currently, there's no information on that. So if you're looking to carry forward, you can still use that next year. But after that next year, we have to wait for a little bit more information.
Yeah, so evolving a new account type with the CRA, and even when it came to launching this in the spring, things were changing right up until the last moment. So appreciate
Yes.
your patience with this, guys, and sorry that we can't give you a clear answer there. Okay, so we're almost at time here. Adam, did you spot any good questions maybe for the Zolo team you wanted to ask, or did you want to wrap things up here?
I think the question that you actually covered right there was kind of what I was looking at. I can look here for another question.
Yeah, there's quite a lot. So in advance, if you guys don't get your questions answered, please feel free to reach out to Questrade. We've got hundreds of new account agents waiting by the phone, waiting on chat to help out. And we're happy to go into some of these questions as long as they're not, personal advice, if we can't cover them in today's webinar.
So this is another one about, I got to be delicate with this one because it is close to a lot of tax, has a lot of tax implications. But someone has asked, can I trade frequently in the FHSA? Essentially, it's a registered account, just like your RRSP or the TFSA, the accounts we also talked about. And with registered accounts, trading frequently, there isn't a lot of exact detail about what the CRA sees as pattern day trading, things like that. So you might want to be careful. For trading frequently, if you're looking to start a frequent trading cycle there, you might want to look at something like a margin account, where it's allows you a lot more freedom of how you would like to trade and allows for a few different investments. But for trading frequently in the FHSA, I would just say be careful and maybe look to talk with a tax professional on that before jumping into that.
Appreciate the insight on that, Adam. Yeah, that's a very common question that we used to get about TFSAs, and FHSA is the same. It's a bit of a gray area. If the CRA came out and actually gave us rules for how much you're allowed to trade, everybody would trade right up to that limit. So it is a bit of an arbitrary ruling on their part. So we can't really tell you X amount of trades or Y amount of trades. Just it's more for longer term investing is what the account's purpose is for. I'll finish off with one last question for Questrade here. Bit of a fun, cheeky one here. Where can you get 8% with Questrade? So maybe referring back to some of those charts that we showed earlier, 8% was just a historical example of the S&P 500 and the TSX 60 over the last 70 years. If you look at the compound returns of the stock market at any given 7-year period, you're going to get about an 8% average, 7.5% average. With Questrade currently, some of our GICs are approaching 6%, I believe, off the top of my head. And depending on what you're invested in the wider markets, 8% is possible, 10% or more. Or you could lose money. So pick your investments carefully, especially if your time horizon is shorter. If you're planning on buying a home in the next 1 or 2 years, maybe potentially consider something that's lower risk, that's more appropriate for your risk tolerance. Can't go into too much detail there because I'm starting to get into advice, but hope that makes sense. And yeah, 8% is definitely possible. So thank you so much again for joining us in the audience today and setting aside almost an hour of your lunchtime. Keep an eye on your inbox for the email recording. And yeah, watch out for the post-webinar survey afterwards. Thank you again, everyone.